Welcome to Recogs, the Inventory Success Podcast, where we discuss how the top operators source, manufacture, and finance in order to sell their inventory to create successful businesses. I'm your host, Mike Gelb, the community manager here at Manufactured. Manufactured is the inventory success platform for B2B companies. This is a recast of a webinar we did about investing in consumer brands, where we talked to two of the top investors when it comes to investing in consumer brands. We speak with Melissa Facchina from City Capital and Megan Bent from Harbinger Ventures. Without further ado, here are Melissa and Megan. Thanks everyone for joining us. I'm Mike. I'm going to be your MC today. I'm the community manager here at MFD. MFD is an inventory financing and operating partner for consumer brands. So if you need inventory PO financing or AR factoring, maybe we could be a pretty good option for you. So we kind of focus on the credit and debt side when it comes to scaling brands, as opposed to these fine folks who focus on the equity side to scaling brands. So really excited here to have both Melissa and Megan. I also have a podcast called Consumer VC, and you two have been some of the most helpful and incredible guests that I've had on the show, and really appreciate all your support with through that show. We'll kind of get started with you, Melissa. Tell us a little bit about yourself, and as well about City Capital, if you don't mind.
Yep, for sure. And before I do so, I will apologize. After I introduce myself, I'm going to go off camera. I was on a lovely Zoom call this morning, went to get my computer and get up, and tripped and smashed my whole computer on the ground. So I'm now a sans computer. So to make sure that this goes smoothly, I'll just move to audio momentarily. I'm Melissa. I'm the co-founder of a growth equity firm called City Capital. City's super unique in the space. We are a private equity firm that blends both capital and operating capability and know-how. We are 1/3 investors, 2/3 operators. We've got several $100 million in assets under management now. We operate both scout funds and primarily growth equity funds. We write $5 to $15 million first checks usually, although our scout funds write $100,000 to $500,000 checks across CPG. I'm an operator at heart, not an investor by trade, although I guess arguably now I am one. I grew up on a manufacturing floor. My dad built the country's largest privately held juice manufacturing businesses. So at 11 years old, I got a factory floor job, whether I wanted it or not. Didn't want it. Thrilled to have had it now. Learned what it meant to be an efficient operator. And I think that's what CPG was lacking in a lot of years. Now, obviously, we know the macroeconomic climate has shifted to a focus of efficiency, which happens to be our know-how. I took that knowledge, built a consulting firm, which ultimately turned into an execution firm, 15 operators. We went in and took over the back end of a lot of food, beverage, and CPG businesses. Built about 550 of those companies, ultimately got the attention of a lot of investors, raised our first $70 million fund one in 1 hour, then went on to raise roughly $150 million fund two. That's us in a nutshell. So we deploy capital and our team side by side, and we care significantly about scale, about pricing architecture, about margin, about making sure that we are building a company and not what I like to loosely call a charity. So that's me and City Capital in a nutshell.
So if it took you 1 hour to raise the 70 million, it took you only 2 hours, right, to raise the 150? Is that right? A little bit?
That would be a really good assumption, and that was the damn assumption I went in with. I got really spoiled. And what I'll tell you is founders often forget, and it's been a very good connecting point for me with them, that I'm a founder also. And that means I have a business to build. I have a culture to build. I have investors to satisfy. And I have to go on the financing campaign myself and beat the drum. And so, yeah, I just to make light of the situation, originally I was like, this fundraising shit is so easy. What are people complaining about? Right? Then obviously the market turns and it's not so easy, even if you have a good product. And I think City Capital is an excellent product. Even if you have knowledge, team, talent, execution, numbers. It doesn't matter if there's people on the other side who don't have the capital to invest. And so it's the same thing for me or for Megan when we need to get capital than it is for you guys who need to receive the capital. We need to be the folks who can get it first in order to be able to give it. So no, it was slightly longer than 2 hours.
Thanks. Well, thanks for all that, Melissa. Really appreciate it. And congrats again on all that you've built with First City Ops and then, of course, City Capital. Megan, tell us a bit about yourself and about Harbinger Ventures.
Absolutely. I'm excited to be on this panel with Melissa. We have some shared values as we approach both consumer and investing. So Megan Bent, founder and managing partner of Harbinger Ventures. Before Harbinger, I was at an investment firm called Revelry Brands and have spent the better part of my career investing in Series A stage consumer businesses that are disrupting large stagnant categories and have a sharp perspective on how to bring health and wellness, transparency, better connectivity with the consumer to their categories. I love this stage. I call it sort of the adolescent stage. It's a little bit awkward. Not everyone, enjoys it, but it's really when the foundation for long-term sustainable both business and brand building occurs. Harbinger specifically invests in food, beverage, personal care, beauty, and wellness. For us, we're looking to take large minority stakes in businesses, roll up our sleeves, and really be partners. Similar to Melissa's firm, we're about 50% operators, 50% investors. And I think that's because we believe that capital's dilutive, intellectual capital is regenerative. And so if we can spend more time with you helping solve problems versus fund problems, that's the best way for us all to generate wealth creation together. And so I'm super excited to spend time today talking about all the different ways we can raise capital, drive growth, because it's not just equity, there's debt and there's internal sources too.
Totally. Well, Megan, thanks so much for joining, and again, congrats on all your success with Harbinger. Just for all the folks that are listening live, if you do have questions, feel free to ask them in the Q&A chat or even just in the chat in general. I will do my best to get to them if they're relevant. And so, but please, we want to try to really make this as helpful as possible. So please submit your questions, and then hopefully we can have two of the finest people that invest in the state of consumer answer them. So this is a really cool opportunity. Well, to start off with, I know we kind of talked about this a little bit prior to starting this webinar, but and as well as what both of you said in your introductions, this is a really challenging year for a consumer. I mean, I spoke to one investor that was at BevNet last, I think it was 2023 BevNet, and he was like, I think that 40% of the brands you see here will unfortunately go bankrupt just because of the kind of nature of course you have you have cost of capital that has obviously risen, and then of course to actually get to the right metrics that the also metrics maybe have shifted in terms of what it takes to actually raise a seed round or a Series A. Let's start with you, Megan, since I know that one of your focuses is that Series A stage. What has your approach to Series A changed in this landscape, and what is your kind of definition of a Series A, where a company needs to be in order for a Series A to make sense?
Sure, absolutely. So I'll start with sort of how we define Series A and then how we've evolved what I'll call underwriting, but that approach to understanding if a company is a good fit for our investment and vice versa to reflect real world changes. So in terms of Series A, I think about seed stage companies are basically in a hypothesis, right? It's an idea that a founder has that is, data backed in terms of the inputs around that hypothesis, and the primary use of funds during the seed stage is to go test it, right? Did the consumer really pay for it? Does the retailer want to put this on its shelf? How much discounting is needed? Did it taste right? Was it efficacious? And that's what we call sort of proof of concept, right? There's real consumers that seem to really like the product, and there's a sense that there's a business here and a brand here that has a reason to be. And equally importantly, that VC funding is the right source of capital for that, because there's a lot of great ideas out there, but they're local, more localized, right? Smaller scale. And that's not the right fit for VC capital. VC capital needs to generate a certain return. And so the hypothesis needs to have a certain scale. Series A, what we think of is these are mini businesses. And so what we look for at the Series A is a really sharp perspective by the founder on the point of difference. So that's not just brand. It has to be all the way down embedded in the formulation, the margin structure, the go-to-market, the channel mix, the marketing mix, a really strong perspective that flows through. A Series A company's made some choices, and those choices we use to evaluate quality of leadership. Who have you hired? How do you manage people? What have you not done and what have you done? When we talked to you a year ago, did you do what you say you were going to do? And so at Series A, we don't have a ton of data, but we have a little data to say, can this idea start to scale into a business? And do we believe that this business addresses an industry, an opportunity, and need that's big enough? And finally, we say, is there both an emotional need and a practical need? Functional needs are what the consumer will pay for. Emotional needs are why they stay with the brand. And so for us, that's all part of our diligence early on to say there has to be a really acute, measurable reason for this company to be, and the business is showing great trends. A Series A company is not perfect. And so I like talking to founders about what's keeping you awake at night? What problems are you trying to solve, right? What's not working and what is working? What have you changed course on? What have you doubled down on? Because all of that information is really valuable to understand. Do we agree on decision making? Are we going to be good partners together? And, as a $3, $4, $5 million brand, there's no way you have all the answers. And so we look for the founders that are willing to say, here's what we're still figuring out, and here's what we feel confident in. So that's our definition of a Series A company. And in terms of how things have changed, look, without getting too technical, cost of capital has to align with the market. And so if we look at basic data over the last 4 years, valuations have dropped somewhere between 40% to 60%. And so there's been massive compression in how companies are valued. And there's a ton of different reasons for that. Some of it is there's less competition, right? Sort of, less funds that are active. I would say tech funds sort of like ran out of consumer as soon as supply chain got hard, and they'll say, we don't really do CPG anymore now. We're back to just pure play tech. And a lot of those funds were driving up valuation. The reality that access to capital on the fund side, access to capital on the debt side is harder, so that makes the risk higher. You pay more. So, when we go into businesses now, we have to think about how hard is it to sell this business, and it's a lot harder. How hard is it going to be to fund this business? It's a lot harder. And how have market multiples changed so that we don't put the company at risk where we overpay today and the next round can't get done because there's a disagreement on valuation methodology. And so we've changed our underwriting. We now look at consumer businesses, and instead of saying, what will a strategic pay for this in 5 years? We say the strategic is the upside case, and let's make sure that this business is strong enough, durable enough that maybe a financial sponsor could be a good partner down the road, which is EBITDA driven. And so we really have sort of changed how we think, not only about multiples, but also how you want to grow these businesses and ensure they have multiple paths to exit, multiple paths to generate wealth for all shareholders. And as one of the earliest investors, we don't want to create a source of misalignment too early. Does that answer the question?
Hey, Mike, this is Melissa. Can I just say something on that real quick? First of all,
yeah, of course. Go for it.
I have to tell you, I often get credited with being able to break down really complex, hard to understand topics into really palatable sound bites. For anyone listening, you just did a tremendous job at breaking that down. No, it's legit, and you deserve that credit. But second, it's funny, the face that you can't see of me right now, I could put on Megan because everything that she just articulated is exactly how Citi tends to look at businesses. We just might look at them a little bit later, as maybe we're the lead of the Series A. We're almost certainly the lead of the Series B. But I think in hearing Megan and her original background and kind of, how her firm is put together, what you heard in similarities between both of us was the term operator. And I think that that's where some of the change in the CPG space has happened to the negative in the last years that hopefully now comes back to the positive. And what I mean by that is we had some great investors and a lot of operators in emerging CPG through, the 2010s. When all of a sudden there was a substantial number of exits, people were getting high, values of projected revenue multiples, money from a variety of places started dumping in CPG, primarily in tech. And to Megan's point, valuations were being driven up that were totally unattainable. I can tell you, we looked at a plant-based cheese business. It had done $700 or $800,000 in sales. I think this was 2018, 2019. They had a $70 million valuation on the company, and the lead investor was a tech investor. That is totally unsustainable. You can't do it. You can't get the business to the place. There's not IP in food and beverage in the same way, and the scalability is not the same. And so I think what's materially important and has started to happen now is as it's gotten harder. Costs have increased. Consumers now have to decide where they want to deploy their dollars. Let's not forget, we all have finite dollars. So as costs increase on the shelf, they're also increasing for gas and for electricity and everywhere else. And so you have to determine what dollars you have to spend, which means brand loyalty becomes a thing again, and or cost becomes a thing, right? If you're fortunate enough to be able to be a premium consumer, you can pay for your brand, but otherwise you might be shopping for cost. That makes it hard for the investors who are trying to price something purely on scale. So what I'm seeing now is a mass exodus of capital in a variety of places in the chain. And really just the hardcore CPG people are left. Now, those hardcore CPG people tend to look at things from the lens of operating, and they tend not to want the overinflated numbers because they need to understand what's practical in a business and what practical cash flow scenarios are. So I'll give you an example. When we see decks that come to us with a hockey stick up and to the right, we actually send them right back and say, we love your business or love what you're doing and would love to try the product. Please try again. Come back to us with projections that are real. And then we're happy to have a conversation with you, because unless and until we know that that founder and or management team can be practical, can take the critique or criticism, is willing to look in the mirror and understand how hard it is to get there, that's probably not a place that expert operators are going to be spending their time, because we're not going to be able to influence the change we need to change, both as investors and operators. So sorry, Megan, I had to jump exactly on what you said because everything you said was spot on.
So, and that's also really well said, Melissa. This is great. I had on my podcast, I had on a incubator that said that incubates consumer brands, like consumer tech brands, I would say, like brands that has, IP, some type of IP associated with their product, but they are consumables. And I asked him what kind of he thinks that the benchmark is for Series A. And I would love to see if this is accurate or not. I know that this also depends and varies. So I understand too if it's kind of not all this, but he thinks of Series A from a metric standpoint, $10 million run rate, cash flow positive, and clear understanding of margins at scale. I just wanted to throw it out there as kind of three benchmarks. Is that roughly right in either of your mind that you think about they think about the Series A, or is there maybe one or two or even all three that you maybe disagree with? Melissa, maybe we'll start with you on this one since it started with Megan on the first one.
Yeah, I always get stuck on a question like this. I'll be totally honest with you, because I don't know that there is an exact number for every single business, every single product type, every single setup. Self-manufactured businesses are extraordinarily different than co-man businesses. Beverage is extraordinarily different than something in frozen, which is different than something in the center of the aisle. And so I don't know that you can blanket it. What I would tell you is I would be shocked if every single company going to raise a Series A, which means they've only taken in some version of seed financing before, is now cash flow positive. Okay, that's the first thing I would tell you. I don't know that that is practical. I have very rarely seen that. It has happened before. It happened mainly during COVID, during direct-to-consumer time, when the world could buy into direct-to-consumer cheaply. Everybody was first order profitable. That's changed a lot. It's really hard to be cash flow positive. Does that mean it's not possible? No, there are some brands who truly are doing it and who have made the right investments in the right product margin to begin with and gone after the right retail and or omni-channel support to get there. I would argue, though, that they don't stay cash flow positive when they have to grow into growth mode, usually. $10 million run rate? Sure. I mean, we see anything between, 3 million, let's say, up to 15 million, to be totally honest with you, when it comes to a Series A. But it also depends on how many rounds were raised before this quote Series A. Let's not forget, people are now calling what used to be bridge rounds, just traditional debt rounds, the convertible note or safes that were designed to be a bridge of 3 months, 6 months, whatever, from one round to the next. And they're using that as a round in and of itself.
Wow.
And so that's an extension of a seed round that often happens, which delays the Series A. In terms of margin, I will tell you, margin really is king. And let me explain that for a second. So a lot of people have been told over the years that scale equals margin. And I think that's erroneous. I personally believe that operational efficiencies equal margin. Scale is one piece of an operational efficiency. But the truth is you need to start from really day one with a product profile that has a relatively healthy margin. And let me tell you what I mean by that. If you come to me and you're starting a product and you have a 6% margin, we got a problem because you ain't getting to 45%, right? If you come at 28 or 31% and it's not fully loaded and you've not even really gotten material revenue yet, now we might have something to work with. And so it really just depends on where you start from. And part of the problem in my mind in emerging CPG is we've been inundated with let's make the ingredient line as clean as possible. Let's strip everything out of it. Let's make everything, as high end and high quality as we can go. And that's wonderful in a niche market with a premium consumer and probably a $10 million, $15 million TAM on what you can actually access. You have to have ingredients that are affordable, and you have to build in manufacturing infrastructure, usually with a co-man at that stage, that can actually produce your product at a rate that you can afford to produce with. So I think margin is critical from the beginning. It doesn't mean it has to be the exact margin that you need the company to be at to sell. It also doesn't mean it needs to be exactly at the cash flow or that it's EBITDA positive where it needs to sell. It means you need to have a true realistic pathway to be able to figure out getting the business to that point. At least that's my interpretation.
Yeah, and on
I
the
think
Series
that's.
A, I was gonna say, and on the
Megan.
Series A metrics, we could negotiate the actual metrics probably by industry. Like beauty, I think you can reach sort of that Series A proof of concept a little earlier. Margins are higher. Other businesses, maybe it's later. What I agree with though is I think the metrics that are throwing out are sort of a derivative of self-control. And at Series A, we want to see the founders demonstrating self-control. So to get to 10 million with good margins, cash flow positive, you have to be making really good decisions around the quality of your revenue, right? All of your products are making money. All of your channels are making money. Your value proposition is making money. So the opportunities to enhance margin are around scale, but like the fundamentals are strong, that I agree with. So when we diligence a company, whether they're 2 million, 5 million, 10 million, through the lens of a Series A, we want run contribution margin by product, by channel. And if you've got a lot of out of control channels, products losing money, but the founder didn't know, channels losing money, but the founder didn't know, they're launching into 7-Eleven, even though they're a $12 popsicle. Those are moments where it's like, I don't care how big you are. We don't yet have sort of agreement on, the business controls or strategic discipline that I think is necessary of the Series A, because you might get 5, 10, $15 million of capital, and we want that capital to be as efficient as possible. So that's where I probably agree, is that the Series A, even if they're still losing money, and most of our Series A companies are losing money, but with a knowledge of where that money is going and the return, but their margins are good and their revenue quality is good. For me, it's a proxy for decision making.
Really appreciate that. We have a couple questions here already, and these are awesome questions. First one from Taylor Wilson. It's really helpful to hear how your fund thinks about the exit path for a consumer. Do you have benchmarks or back of the napkin calculations that you use to understand the max amount of dilutive capital a consumer company should take to ensure it's still attractive for an exit?
The answer is yes, it is a mathematical exercise. It's more of a variable equation than is simply put, because it depends on when you raise that capital and how much capital it's when you raise the capital and at what valuation. So for example, you may only raise $10 million, but if you raise it at a $150 million valuation and the average exit in your space is $150 million, that investor is going to be unhappy and create problems for you when you go try to sell the business at an average exit. So what I like to do is sort of do deep TAM work and, M&A work to say, if you're a cereal bar company and, you pull the comps on average exit multiples, and make sure that you're not raising capital at valuations that basically price you out of a normalized exit. So that's fun one. That's basis number one, right? Valuation expectation management. And the TAM and the valuation of the industry you're in will start to dictate how much equity you should really raise. Each round, those capital investors will have expectations on return. So those are internal expectations. If you raise a venture round, a seed round, they're probably underwriting to 10 times their money. So if you've raised at a 10 million post, now you have to deliver 100 million in value for them to feel like they did great with you. If you raise a Series A, maybe they're underwriting to 4 to 5 times multiple. So these are things where it's like a co-underwriting exercise, where I encourage companies to ask the investors, will you be open with me around your expectations for this business, right? As a fund, what are you underwriting to? What kind of exits satisfy your fund? What makes you happy as an investor? What wouldn't make you happy as an investor? It allows you to have much more visibility early on into where sources of tension are, where if you start to grow too slowly or decelerate, you create too much dilution, you raise too much money at too high of a valuation, you can start to basically understand where you're removing optionality and or potentially creating misalignment. So I don't have an easy number, but I would say in CPG, a classic kind of consumer packaged goods business and exit, these are not multi-billion-dollar exits unless you're Kellanova. If you're a single brand, these are sub-billion-dollar exits. They're probably sub-$500 million exits. And so when you think about your last round of financing and the expectations, you're more conservative than if you were a tech company. Melissa,
I love what you
Go
just
for Melissa.
said. I just want to partner with Megan in all the deals we do. Really,
I'll do A, you do B. Call me.
No problem. I will say, and I'll say one thing and then harp on something more specifically that Megan called out. But one is in terms of expectation of investor, managing that is complicated, and it starts with you asking the right questions. We do something I think is unique. Maybe it's not unique now hearing Megan, but we will literally sit our founders down or the management teams and show them how we have mapped out their business. Not just operationally, but truly from a cash in, investment in, expectation out perspective. Each incoming round that we would expect to happen and when, what that does to their list of current investors, to us, to them, to their equity pool with their team, just so that they can see what the business actually has to do to get the output that folks want from them. And then second, set their expectations around the fact that they have stakeholders at the table that might have all different expectations of that company. And so it's really hard, by the way, as your business grows, where you have a board put together and you still have a seed investor who's on the board with a Series C investor, as an example, because they have the seed investor really has made their money back likely at the Series C, B or C price that investor came in. They're no longer motivated to keep building the business. It's a very different outcome. So you have to work through those dynamics, and it can be very challenging where you've got folks who are not willing to support transactions, financings, what needs to happen in the business, because the outcome for them may be tainted as a result of that. But if I dive a little bit deeper into the investor-investee dynamic, and the reason I'm going there is I'm personally passionate about it. It is the number one reason I launched City Capital. I felt that having built so many companies from a city ops perspective, I saw the erosion over the years between investors and investees. And what I started witnessing was a lot of investors who didn't really understand how to build CPG businesses were putting impractical asks on these companies. And then the companies couldn't achieve the impractical asks. And then the investors were turning around and penalizing them for that, whether it was in a ding evaluation, whether it was in stretching out erroneous terms, whatever it was, there was some sort of ding for it, and certainly a loss of trust. So what that ultimately created was this feeling that we have to hide things from our investors. And we go into a business and tell everyone, you can't hide anything from us, because the diligence we do, City Capital actually started because we were the diligence firm to 44 different VCs, PEs, family offices, and sovereign wealth funds. So we will rip apart your business in the nicest, most respectful, friendliest way possible, and then tell you all the things that you need to do to achieve your goals, or all the things that you might be doing wrong that we should think about changing. So we're going to find the problems. Don't hide them. Let us help you solve them. We're not going to fault you for them. But the reason I call attention to this is I think there's a misinterpretation that just because an investor wants to write you a check doesn't mean that they are the best investor or the right investor for your company. Just like you might want a specific firm to write a check for you, but that doesn't mean that you're the right fit for that firm. And so I think we need to have a two-way street where investors are getting almost interviewed in the same way that brands are getting interviewed, so that we understand, back to Megan's point on expectation, that we're all talking about being able to achieve the same things.
I think that these are, wonderful, awesome points. I would also add, I think obviously valuation, and in terms of how much money that you're kind of raising, or the actual percentage of your business you're actually selling, right, to the investors. Obviously, that's super important when as well thinking about an attractive exit. Also, just one of the terms as well, just wanted to call out one we haven't really talked about is also, like what the actual waterfall and the liquidation preference would be. Something that I think still gets a little bit overlooked. If like an investor has, 3x liquidation preferences, then it means that they will actually be the first ones to receive 3x of their money before the waterfall, before everyone else receives money. I think that's kind of incredibly important. Just to know that going in, that you have actually done that, even if that's at like, maybe a better valuation for you as a founder, for example, and that you've given up less of your business, but you might do have 3x or even maybe beyond a 3x liquidation preference. So I think that that's just another term that I think that that's also really important when you're thinking about as a founder. Okay, what do we achieve in order for successful exit for me? When it comes to that makes sense that in terms of that's attractive for myself. So just another just kind of quick call out there.
I agree with you so much. When founders get term sheets, there tends to be a focus on valuation and percent dilution, right? So those are the two areas of focus where you're like, what's the valuation? What's the percent dilution? And then you sort of focus on the like, who's going to join the board? And then everything else you hand over to the lawyer and you're like, just do your thing. And I would highly recommend that founders get much more curious around the governance of their business, like these corporate documents that give investors blocking rights. Like all of a sudden you're like, oh, wait, I'm not allowed to give myself a raise without my lead investor. Oh, wait, I'm not allowed to take on debt without my lead investor. Like, oh, I didn't realize I have to get my budget approved every single year by my lead investor. That didn't feel like a big deal, but now it is a big deal. And those are sort of like micro irritants. And the pref stack is another one, which is, 1, 2, 3 times your money, or these things that compound over time. So it's like in your head, I'm going to sell this business in 3 years and 8 times preferred return, 8% preferred returns, not a big deal. But if you're in that business for 9 years, all of a sudden that's a really big deal. And so I would highly encourage founders to get someone to draw up the waterfall for them and run the numbers, in your dream scenario, your worst case scenario, think about precedent. And you may find that you take a little less capital, a little less valuation, in a partnership that feels more aligned, where you fail, I failed sort of thing. Investors are always going to get their money back first, probably, right? But they don't need to get multiples on it if there's no distress, if it's a normal round. So just, the dork in me just is piling on to say, these are really important things that are really worth spending a lot of time and being curious about.
Yeah, I'll add to that too, that we've noticed that over this last year and a half in challenging fundraising environment, that what I will label as egregious terms are coming out a lot more than what came out before. And obviously investors have to protect their capital to some degree. There's a wide variety of ways to do that. But generally speaking, how I encourage not just my investment team, but the founders that we're backing to think about this is, can we just walk through where this is going to get us the next time around? So this might all feel good for the investors today that we ask for these things. The founder may or may not really understand it, but they might feel like they're in a position where they have to take it. And so they're going to do it anyway. But like, guys, does this really do us any freaking good the next time around? Because you know what I just signaled to the next investor behind me? That this business was in freaking trouble for me to ask for that type of a waterfall or a liquidation preference. And so that doesn't mean that there's not some city. I will tell you, we certainly have 1.5X's out there. I think we even have a 2X out there. Like, we definitely have had times where we have had to utilize situations like this. It's for good reason. We always stand up, by the way, to be the investor the next time around in that environment if we have to, or explain the reasons why this has happened and to the next lead investor, and be willing to strip away some of the governance that we put around the business to stabilize it. That's usually our MO, by the way, is we just want to stabilize the business. We're probably not the last check in. We're not the final check like the VMGs of the world where we can write a $40 or $50 million check. We're the check right before the last check. So we have to be careful in what perception we give after the fact. But I'll tell you, the next thing I coach our founders through on a consistent basis is, you're going to get diluted. Let's understand what that dilution means for you. And let's try and pick investment partners, Citi included, that can build back an equity incentive program for you if you get too diluted based on merits that you're achieving and the business is achieving, because frankly, we all need to be rowing in the same direction. So if the business is getting stronger, you should get rewarded for that. If the business is weak and the investor has to step in and either strengthen it or stop the death spiral, that honestly, the investor should be getting something for that risk. But the moment the company turns around as a result of that, we should change the direction. And I don't think investors should be leveraging what would manage risk profiles, like some of the things we're talking about here in a 3x liquidation preference, as regular terms in a challenging market to raise in. That's just unfair.
Totally. I think that's really well said. I mean, on a past interview, I talked with Teddy Townsend, who's a banker, and she focuses on health and wellness businesses, and she said that there definitely are on the podcast episode publicly. So that's why I'm happy to share it publicly because it was public. But she shared that how you have great businesses, right? And founders at the time optimized for a much higher valuation and were able to get these higher valuations. But at the same time, the cost was maybe 3x liquidation preference. And now these businesses are kind of coming to market to be sold, but they actually are right now at a standstill because it's not it's not an evaluation that makes sense for the founder because there's that 3x liquidation preference. The investors is fine with it, but the founder, the kind of operations team is not. So this could lead to, not saying it does but it's just something that definitely founders I think should be kind of careful with or just aware that this is that is just another deal term for sure. And then so this is a great question too from Liz. It's something that I think about quite a lot. Profitability has become much more of a focus of investors in today's market, which generally comes at the cost of growth, or at least high growth. What advice do you give your brands on how to navigate these equally important priorities? It's interesting. Just this is like a caveat. I was talking to an investor who had the opinion that if really you're going for profitability, like that kind of means that you probably aren't able to fundraise. And yes, get profitable, then go and get profitable. But at the same time, if you really are trying to become a company that is attractive, for example, to a strategic or PE firm or even maybe the public markets, if you actually reach that level, then really you should be striving for growth. So I'm kind of curious, both Megan, Melissa, how you kind of I'm sure you will both get this question many times. I know that I probably this is not the first time, but what are you kind of advising your founders? What is, like, for example, operational efficiency, Melissa, that you kind of spoke about in terms of what metrics like you're looking out for when it comes to if a company is true operationally efficient, and how do you kind of measure this whole profitability versus growth kind of balance beam almost that founders are juggling? We'll start with you, Melissa, since I think I started with Megan last time.
Yeah, for sure. So to answer your question on operational efficiency, I think of operations, or how we think about it here at Citi, is that it's cyclical. So when you make one change in your back end supply chain, that change then dominoes to another change and another change and another change. That by the time you make edits, you're kind of back around to the beginning decision again of what you started with, and that likely now needs yet another change. What I mean by that is we're now opening new retailers. Let's look at where our warehousing and logistics and 3PL providers are. Okay, we're going to, it makes sense based on the volume to open up one of these stations close to this new massive retailer that we have opening. Great. But as the year progresses and you're now opening new DCs or new retailers, what you may have opened in California is no longer efficient for what you're sending or shipping or needing to fulfill in New Jersey. So now we need to think about how to solve for a cost efficiency in those type of distribution centers. That same thing goes through with suppliers, how you're buying each raw good or bulk, how you're buying your packaging. It goes through how you're negotiating your tolling or your co-man agreements based on volume. All of these things have edits as you grow that you constantly need to be checking the cost that you're paying for things, where and how you're moving your materials, and how many touch points these materials are having. Because every time a material is touched, you have to think about it as it costs money. So those are one of the things that Citi, as an example, focuses a lot on. I'll give you an example. We wrote a check to a Canadian business about 18 months ago. I happen to be buying another Canadian business at the moment, but that's not the one I'm referencing. This happens to be a very well-known Canadian chocolate business who puts their whole life out on social media. So you should determine who that is. And we wrote our first check, and in diligence realized that they had a very inefficient supply chain. They self-manufacture, but moving their goods from their factory to US distribution was out of whack. We took over, and in, I think, 45 or 60 days had restructured that supply chain, where we saved that company $5 million in perpetuity annually based on just restructuring how they were moving product. That's just one example. So I think that, and I forget what your actual question was aside from operational efficiency, but for me, it's all about how can we eke sense out of the system, because a lot of people look at eking dollars out of a system. Cents ultimately turn to dollars, but most of the time you will gain points of margin in just constantly tweaking your back end. Now, when you're small and making big moves, those steps obviously can be much bigger and create a much bigger dynamic in your financial plan than if you're a 75, 100, $150 million business. Those tweaks are small tweaks. They end up to large dollars, but they're small tweaks that do that. So it just depends on the stage business and how you want to build that in. And frankly, that, in my opinion, is generally what drives the cash need in the company. I remember what we were talking about, which was profitability and growth. It is a very hard balance. We saw the rug get pulled out from under in founders 2 years ago, where everyone said, stop the growth at all cost model. That's what you built your company on. That's what you raised your first investment dollars on. That's what you promised your investors with. And that's what your, pro forma looks like. That's incorrect. Halt it all and now start building the bottom line. Most of these founders, to be honest with you, were not equipped for that. They're sales and marketing founders. They don't have the chops to build that type of foundation where they're focusing on the bottom line. They didn't know what to do, and way too much of an overcorrection went into only profitable and not looking at growth. So now we're back to this. Yes, we have to grow top line, but we have to try and do it profitably. So one of the things, just as a trick to you guys, that we sit with our companies and do is, let's look at every retailer. Let's look at every channel we're selling into. Let's understand what each one of these is costing us. And let's pretend we have 10 of them. We can afford to have one of those be what I would call pie in the sky. We are losing money on it. It is a marketing expense, but we think it's valuable because, it has a name that will get us places later. Great. But the rest of your 9 out of 10 that you're selling to better be profitable, or you're going to get yourself in trouble, or at least close to profitable, right? And a pathway of adding doors to profitability. So I think we try and look at every time a product leaves and goes somewhere, what are you making on that product? And we need to have more of the ones that are making positive marks and less of the ones that are making negative marks, and slowly move a business in that trajectory.
Mm-hmm. I think profitability has always been fundamentally valuable in consumer. It's just been kind of buried below revenue multiples. If you dig deep and you look at some of the highest multiple transactions in CPG, often it's accompanied by really profitable companies like Tate's Cookies, right, at 20% EBITDA margins and transacted above industry averages on a revenue multiple, but clearly it's because it was so margin accretive to the acquirer's business. And so I think margins, contribution margin, adjusted EBITDA have always mattered to these underlying buyers, with some exceptions where they got seduced into acquiring a consumer base at a loss, like a Dollar Shave Club, right? And then there was huge indigestion after that from the buyer who's like, well, let's not do that again, right? And so I think growth and margin have always been really fundamental in the businesses. I come from a group of mentors where it's like the Food Should Taste Goods and the Bare Nakeds and the Evils and the Siggies, where they grew really capital efficiently because VC capital didn't really exist at the time of business building. And so my bias in these businesses is profitable growth is totally feasible. Profitable rapid growth is totally feasible. It requires you to sequence distribution and decision making really thoughtfully, right? You can't do it all because you can't measure it all fast enough. You can't fund it all fast enough. It requires fixed expenses ballooning to support, complex distribution too fast enough. And so when founders and I talk about growth versus profit, I'm like, I want to find the growth and profit. So like, let's go through the business channel by channel, product by product, customer by customer, marketing channel by marketing channel, and look where we see the two intersecting. Where do you see growth and profit? That's where we're doubling down. Anywhere you're making money, that's where we double down. That's what we resource. That's what we continue to fund. Anywhere it's not, we put it on the back burner, right? This is something that's going to drag against your goal, which is growth and profit. Because when you get those two combined, you get these sort of regenerative benefits, compounding growth, which is more and more efficient, right? That's loyalty, that's retained consumers repurchasing, which aren't paid for. So that's what we're pushing for. That's what we're looking for. I think what's really challenging is when a business has been growing and told, don't worry about bottom line, and then is required to quickly look at bottom line. And if that has to be done quickly, you can cut too deep, right? You sort of cut down to the bone, growth stalls, you cut more, and you get into what feels like a downward cycle where it does feel like, because of cash pressure, it's growth or profit, because restarting that flywheel is very, very challenging. And so that I'm empathetic with and have been in those circumstances. Most businesses, though, when you go through the exercise of, hey, we're growing, but we need more profit, there is often real opportunity before you really start to concede on those marketing dollars. So that's in fixed expenses, that's in, T&E, it could be in, pennies that are found in freight or warehouse. And so that exercise of like going through your promo dollars, your slotting dollars, your returns policy, all of the different components of your costs, how are those efficiencies being managed, who's accountable for them, all the way down to team. We have been amazed by, you say to teams, we need to take 30% out of this business. They say, no way. And a year later, they're 30% lighter, leaner, and happier, right? It's like, wow, I have less people to manage. I have less headaches to manage. I'm dealing with less problems because you went through the exercise of really saying, this is not a priority. This is not making money. This is a waste of time. And those businesses can have the benefit of being a lot simpler. It's hard work, though. It's detailed work. It's sort of forensic.
Totally, absolutely. That makes a ton of sense. I think my big takeaway is just examining every sales channel, as well as every how you actually kind of construct the product, started from the all the way from sourcing raw ingredients all the way to the actual manufacturing, as well as can you actually save money on shipping. And I feel like with shipping, it's one of those things where it's like, oh, it's just like maybe a small percentage, but it could be huge as you obviously scale, and a small percentage could still impact your margin in a big way. We've had a this is probably the final question from Chris. I just want to make sure we answer all the questions here. What strategic investments and operational efficiencies would you prioritize at his stage, which is pre-revenue, to maximize their runway while building a strong foundation for scalable growth? Maybe we'll start with you, Megan, for that one.
Sure. I'll leave the experts to the experts. I'll leave operations for Melissa. I am a huge proponent of research, and there's so much research that you can do that's really affordable. But before you launch, and this is research that you can do in your own focus groups, paid research, social listening, social research, but in all of our businesses, really understanding at a quantitative level the consumer insight you're going after has been transformational. So even when we're cutting costs in other businesses, or even if a business is, tiny, I'm a proponent of talking to the consumer, understanding the category, understanding the attitudes and usage of the category, and where you're going to play. What is your perspective? How far does that get you? What does that mean on pricing and positioning and packaging? And holding yourself accountable to it. I think it's really easy for founders to fall in love with their own product and assume that a bigger universe of consumers relates to it the way they do, and or to listen to a vocal minority. You know, our social community tells us this product isn't different. So from a value proposition, consumer getting launched, you know, take the time, spend a little bit of money to do a bit of quantitative research to gut check that your instincts are backed up by consumer insights, because that should kind of get you the revenue level. Melissa?
Yeah, that is excellent feedback. And honestly, it's funny because we can talk about operational efficiencies that are typical, which is let's make sure we're sourcing the right raw goods from the suppliers that have the best quality and the lowest costs. Let's make sure you're negotiating, likely buying in bulk, assuming you're buying your raw goods and your co-man isn't. Let's make sure so many founders in let's call it sub $3 million companies who are like buying packaging from Uline as an example. And there's nothing more expensive than buying corrugated boxes from Uline. So, those are all easy things to talk about. I'm going to go in a direction. And by the way, if you want to talk about that kind of stuff in more depth, feel free to reach out to me. But I'm going to talk about a different direction, which is sort of a direction Megan took it in, which is how do you actually spend some money to save a broader amount of money? And one of the areas that I see that people skimp on constantly that ends up coming back and potentially biting them in the ass in a very problematic way is legal. And I'm not talking about spending $200,000 on corporate governance documents, right? I'm talking about manufacturing agreements, supplier agreements, making sure that your product is Prop 65 compliant. We see literally every single day where we have sharks coming out of the woodwork taking products down for a $50,000 legal fee because they're not Prop 65 compliant, or because they have an ADA claim on their website that they didn't even know they had. Or my biggest one, and I will scare all of you by telling you this, I have personally negotiated over 1,900 commercial arrangements, mainly co-manufacturing arrangements across the globe in my career. And a vast majority of those, we care about not just protecting what the brand has, but ultimately whose responsibility is it if something goes wrong? And I'll tell you, when I look back over the years, I've got approximately $70 million that we have had to go back and purchase the formulations that the brands rightfully owned, but they went on the floor of a co-man, sans agreement, sans trial agreement, and they basically, and some of these brands became very successful, and only once you become very successful does the co-man turn around and say, you know what, wait a minute, I actually own that formula. And now you need to go and buy it back from them. You're seeing co-man disagreements or disputes in the news now with Prime. We saw it a few years ago with Beyond Meat. These things are worth spending a few $1,000s on now to get locked up so that you don't end up with a 20, 50, 100, 200,000 multi-million-dollar scenario later. I'll give you one other very scary feat. We were negotiating a buyout with a $100 million snack brand with a very large conglomerate. That snack brand had an inefficient, or really an unstable manufacturing relationship. It was spun out of a manufacturer, and they didn't properly document the fact that now this brand actually owns the product. The buyer offered approximately $375 million for the business. Then they went into, which was almost a 4x revenue multiple. They went into the business and discovered that they did not have this ownership properly documented, nor kind of line space secured over time. It was an innovative product. And they lowered their offer to the business to $140 million. That just lost that company nearly $300 million in a purchase price. They obviously didn't end up selling the business then, kept the business and sold it to private equity a few years later. But that is so simple. And we called it out, by the way, to them very early on. We need to get this stuff papered, and we just kept getting ignored. And so these are the kinds of things that you think are not normal when you're talking about solving gaps or operational efficiencies, but that can come back in such a material way that the cost is so extensive, it is worth the effort now.
Really great examples. And this has been, I know we're out of time, but this has been incredible. We might have to do a part two if you're both game, because I feel like I had like 15 questions and I only like asked like 3 or 4 of them, because you both just incredible responses. And this is just so amazing to do. Melissa and Megan, thank you both so much for your time. Thank you so much for this. Everyone that attended live, thanks so much for listening. And if you're listening on our podcast, also thanks so much for listening. I hope this was helpful. This was super helpful for me. So I hope it was helpful for you. Thank you.
Thank you,
Thank
Mike.
you.
Thanks, Melissa.
Thanks, Megan.
And there you have it. That was super fun webinar, really engaging. Really enjoyed the questions that folks were asking live, that were able to tune in live for the webinar. I really hope this content is helpful for you and your business. And not only do we produce content that hopefully is helpful, but we also throw events as well. Check out manufacturer.com/events, where we're bringing together the emerging consumer ecosystem and SMBs. Thanks for listening.